Today we're going to do a deep dive into interest rates. We know it is the number one topic. It is the number one question that we get asked by homeowners, by potential homeowners, by real estate agents, by everyone in the industry. What is happening with interest rates? When can we expect them to come down? So today I'm going to give a full analysis as to why interest rates could come down, but then also give a reasons as to why they may stay the same. Okay, so we can look at it from both perspectives. That's the best way to look at it. Always want to check your bias. Of course, everyone in the mortgage industry, we want interest rates to come down. We want interest rates to come down for our consumers, absolutely. But you have to check your bias. So let's look at the reasons why we believe interest rates could be headed in the right direction. The first one is going to be the Fed. Now, this is a unique one. Okay, this is more of like a game theory. So as of right now, the Fed, remember, they control short-term interest rates, not long-term interest rates. That being said, the direction of the trend is still very important, okay? So right now, the Fed has been holding interest rates steady for probably about 9 months, 12 months now, okay? And obviously, the prediction is that the first rate cut for this year will be on 9/17. I do believe that's the case. I've said it for about 5 months now. First interest rate cut will be on 9/17. But let's look at the game theory. What's going to happen? Jerome Powell is the Fed chairman, okay? His time is up in May of next year. We know they are going to start the interview process for the next Fed chairman after Labor Day. Today, Treasury Secretary Scott Bessent even said that, hey, interest rates are way too high. We need to bring down interest rates. Okay, so we know the Trump administration is going to appoint the next Fed chairman. If you don't think they're going to appoint a Fed chairman that has the same mindset as them, you're crazy. They are going to. The Fed is supposed to remain independent of the administration. That being said, again, whoever's going to be appointed is definitely going to have the opinions of the Trump administration in regards to lower mortgage interest rates. In addition, let's just take a look at all this historical evidence over the last 3 or 4 weeks. All right, the Fed meeting 2 weeks ago, we had two federal chairmen dissent, meaning they disagreed. Those two people said that interest rates should be coming down. We had another one that basically quit their job last week. Now we have another one today, Lisa Cook, who is currently under investigation for mortgage fraud, right? That's another Fed governor. Well, this investigation by Lisa Cook, what do you think is going to happen with Lisa Cook in the next few days? My opinion, likely is going to resign. So now we will have a new Fed chairman in May of next year, but we will also have new appointees who will likely be in favor of interest rate cuts in the near future, okay? So that is obviously more of a game theory perspective. As of right now, the Fed has been very adamant about keeping interest rates the same, where they have been this year. They're going to be cutting, but the influence of our government is going to start pushing them lower. And again, rightfully so. They want to unlock the economy. The housing industry is so incredibly important. It ties into so many facets of our economy that lowering interest rates absolutely will stimulate GDP. It will stimulate the economy. So that is the number one reason. In addition, right, we want to look at construction or labor construction. So if you go look at historical evidence, labor construction is a great leading indicator for a recession. Okay, go look at the last 4 or 5 recessions. Whenever there is job loss in residential construction, we have a recession. So you see headlines over the last 2 or 3 years, this tech job lays off this tech job this. Yet unemployment rate has been 4% or ranging between 3.5 to 4.5% over the last 2 years, right? Unemployment rate is historically low. We're not seeing jobless claims rights. We're not seeing major employment. And it's because residential construction is truly what drives the unemployment rate and truly what drives this, okay? So for the past 14 years, we've seen residential construction, with the exception of COVID, just been hitting all-time highs year after year, year after year, 14 consecutive years. For the last 4 months, we have finally started to see a dip in residential construction. Why? Builders are starting to feel the pinch. They're starting to feel the pressure, okay? Well, when builders are not going to be applying for permits to build new homes, well, then what do? They need to maintain their margins. They need to then lay off residential construction. When you start to see layoffs in residential construction happen, you see jobless claims rise, you see the unemployment rate rises. And again, go look at it. 10 years, 12 years, 20 years, residential construction leads all recessions. So again, we've now seen it 4 consecutive months we're seeing residential construction start to slow down. It's very modest though, okay? So I want to highlight that. Very, very modest. It's a small dip, but hey, we're starting to see it. Does this continue to accelerate? The answer is yes. It is going to continue to accelerate if interest rates remain high. Simply put, there are enough buyers, but there's not enough buyers willing to buy at today's interest rates, not enough buyers that can qualify at today's interest rates, so it's just not going to happen. So we know the only way to keep residential construction from really having this mass labor loss is to lower interest rates, right? Stimulate builders for wanting to build, for want to apply for permits. And then guess what? You will not see some type of labor loss. And remember, the Fed does not want a labor loss, right? They have a dual job. Keep inflation low, keep labor high, right? And remember, labor over inflation. Labor is always going to be 10x more important than inflation. So that's where it'll be very important that we want to see interest rates come down, because then that will give builders a more of an appetite to want to build, okay? So those are the two major reasons that why we believe interest rates are going to come down. Now let's look at the anti-effect. Let's look at the reason why we believe interest rates could remain the same. And of course, we've talked about it over the past few months, and it is tariffs. It is inflation, okay? So right now, we're about 20 days into the month of August. Inflation rate in the month of August right now, from a month-over-month perspective, is 0.3. This is by the Cleveland Fed. It's very likely going to end at 0.3. So right now, headline inflation is 2.7. It's likely going to raise all the way up to 2.8%. That comes out September 10th, 11th, 12th. I can't remember which day it comes out in September, but expect it. September 10th, inflation rate is going to rise to 2.8%. Now, the real kicker is when you annualize out the last 3 months of inflation. Inflation in the last 3 months have been a 0.3%, 0.2, and 0.3. Total number, 0.8% over the last quarter. So what we do is we annualize that out over a year. 0.8% over a quarter multiplied by 4 equals 3.2% inflation rate. Well, let's look at the last 3 months. June, July, August. When was Liberation Day? Liberation Day was in April. Does take about 60 days for all of the tariffs to take an effect, right? Then guess what? Okay, 60 days, June, July, August, last 3 months, inflation rate annualized at 3.2%. That's much higher than that Fed target of 2%. So that is worrisome, right? You continue to hear people in the media, you continue to hear the Fed people talk about this. Well, do tariffs bring back inflation? We haven't seen a drastic amount of that, but we are just seeing small signs of it. And this will continue to give the Fed ammunition that, hey, okay, inflation is starting to accelerate. Let's keep interest rates high. Let's slow down. And then remember, even though the Fed controls the short term, the 10-year Treasury and mortgage-backed securities, they're going to react accordingly, okay? So the 10-year is going to react in a way that, hey, labor weak, interest rates fall, inflation high, interest rates high, right? We're going to see that stability. So it's going to be very interesting to watch this all play out over the next 60, 90 days. Some very important data points. Overall, from my perspective, I am still of the opinion that interest rates will continue to trend down over the course of the next 60, 90, 120 days, right? I'm just a big believer is, hey, they're not going to 5. I want to make sure I highlight that now. We're not seeing 4.99. We're not seeing 5. You're not going to see this, not without some discount points, okay? But we've also seen in the past that a 5.875 to a 6.125% interest rate, that is enough to stimulate the housing economy. Interest rates have been above 6% for 3 consecutive years now. Twice in these past 3 years, interest rates have fallen to this 6.1% level. Both of those times when we've fallen to that 6.1% level, we've seen a massive increase in transactions, home buyers. So again, 6.1 is enough to stimulate the housing industry. Maybe, just maybe we'll get a little bit lower, but that's all we need. We don't need 5. We don't need that. Would it be nice? Of course, right? But also for your home sellers, home buyers, remain that perspective. 6 is where we're at. 6.125 is the goal. It will bring back a lot of home buyers, a lot of home sellers, and transactions. So that is what we have today. If you guys have any questions, feel free to reach out.